Hello, brilliant minds and curious souls. Welcome back to the Deep Dive, your shortcut to being genuinely well-informed.
Great to be here.
Our mission here is pretty simple. We take complex, sometimes really dense information stacks of research, articles, our own notes sometimes, and we just unpack it, make it accessible, fascinating, and hopefully, spark a few aha moments for you along the way.
Definitely the goal.
Today, we're diving into a topic that maybe at first glance sounds a bit dry, the cash cycle. But honestly, stick with us because by the end of this deep dive, I think you'll see just how critical and, well, surprisingly dramatic this whole area can be.
Oh, absolutely. It seems technical, but it's where a lot of action happens.
We've got this really rich set of sources, all about how money actually moves in and out of a business, the built-in dangers, and crucially, how to keep it safe, how to stop it from being misused.
The protective side.
So our deep dive today is really about uncovering some of the, well, pretty cunning ways cash can be diverted or maybe misrepresented. And then we'll get into the clever, sometimes meticulous methods that experts use to spot this stuff and prevent it.
It's like financial detective work, in a way.
Exactly. Like becoming a financial detective, understanding the vulnerabilities, but also the safeguards, how you build that fortress around a company's cash, which is, after all, its most liquid asset.
And that's truly foundational, isn't it? Doesn't matter the size of the organization or the industry, really. Understanding this cash cycle, it's not just about stopping loss. It's really the very first critical step towards ensuring, robust financial health, stability. If you don't have a firm grip on how cash flows and the controls around it, a business is kind of operating on shaky ground, often without even knowing it, exposed to some pretty significant risks.
Shaky ground.
Yeah.
Yeah, that sounds about right. Okay, let's unpack this then. Our sources really emphasize why cash is seen as such a high-risk area for, like, any business. It seems a bit counterintuitive, doesn't it? The very thing you need to survive is also a huge vulnerability. What makes it so uniquely tricky?
Well, it really boils down to one fundamental truth. Cash is the most liquid asset a business has.
Liquid, meaning easy to spend, easy to move.
Exactly. Think about it. It's immediately convertible, right?
Yeah.
Universally accepted. And often, once it's gone, it's pretty much untraceable.
Ah.
So this makes it an incredibly attractive target for anyone, unfortunately, looking to divert funds for their own gain. And when a system of internal controls is weak, well, it's like leaving the front door wide open with cash sitting right there.
Just asking for trouble.
Pretty much. Our sources highlight two particularly common and actually quite sophisticated cash fraud schemes that really illustrate these vulnerabilities there. Lapping and kiting.
Lapping and kiting.
Okay. And these aren't just, simple smash and grab thefts. They involve a calculated, often escalating series of deceptions. They're designed specifically to conceal the wrongdoing, buying the fraudster time.
Okay, let's tackle lapping first.
Yeah.
The name almost sounds gentle, like waves lapping on a shore. But I get the feeling from our sources it's anything but gentle. What exactly is lapping and how does this deception actually work?
Yeah, the name is a bit misleading. Lapping is a deceptive practice where theft of cash is deliberately concealed. And the way it's concealed is by failing to properly account for incoming customer payments, specifically within accounts receivable. It's really a manipulation of customer account balances.
Okay, manipulating the balances. How?
So here's the mechanism. Imagine you have an employee who has access to both the incoming customer payments, the checks, the cash, and the accounting records for those payments, the accounts receivable ledger.
Right, a crucial combination.
A very dangerous combination. So customer A sends in a payment. The employee, instead of recording that payment and depositing the funds properly, simply pockets the cash or diverts the check for their own personal use.
Okay, step one, the theft.
Step one. Now, if they just left it there, what would happen? Eventually, customer A would get a late payment notice, right? Or maybe a statement showing they still owe the money.
And they'd call up confused or angry.
Exactly. And that would expose the theft pretty quickly. So to prevent this, the employee takes a subsequent payment, let's say one that comes in from customer B. And they use customer B's money to apply to customer A's account in the records.
So it looks like customer A paid on time.
Precisely. It laps the payment. Customer B's money covers customer A's previously unrecorded payment. But now, of course, customer B's account is wrong. It's showing as outstanding, even though they paid.
Oh, I see this cycle starting.
Right. So the employee then has to use a payment from customer C to cover customer B's account, then customer D's payment for customer C's account, and so on and so on.
So it's this continuous escalating cycle. always using new receipts to cover the older thefts, and just constantly shifting this hole in the accounts from one customer to the next.
You got it.
It reminds me of that saying, borrowing from Peter to pay Paul.
Exactly that.
And borrowing from John to pay Peter, just endlessly hoping nobody notices this growing chain of unsettled debts.
Wow. It sounds like a real financial house of cards, just waiting to collapse.
That's a perfect analogy.
Yeah.
It is a house of cards.
Yeah.
And you've hit the core challenge. It creates this sort of musical chairs with cash. The music eventually has to stop, right? Either the fraudster can't find a new large enough receipt quickly enough to cover the last hole, or some kind of independent check finally catches up.
The whole thing falls apart. The whole thing falls apart. What's really insightful about lapping isn't just the mechanism, but, as you said, how it feeds on this desperate hope. It's an escalating lie. Each new payment just kicks the can down the road, making the hole bigger and harder to fill. And that's why our sources really emphasize several crucial safeguards against lapping. Each one is designed to break that chain of deception, to make that house of cards fall sooner rather than later.
Okay, so what are these safeguards? How do you stop it?
Well, firstly, a really critical one is an independent comparison of recorded cash receipts with the funds actually deposited.
Independent meaning someone else does it.
Yes. Someone other than the person handling the cash or recording the initial receipt, they need to reconcile what the company's books say was received against what the bank statement says was actually deposited. Any discrepancy there, that's an immediate red flag. It often catches the problem before it can be lapped away across multiple accounts.
Makes sense. Check the inflow versus the deposit.
Exactly. Secondly, and this is, well, paramount, really, separation of duties. We'll talk more about this later, but it's huge for cash.
Okay.
Specifically for lapping, the incoming receipts, meaning the physical mail, the checks, often handled maybe by a mailroom or a cashier, that function needs to be strictly separated from the people handling the subsidiary account's receivable remittance advices. That's usually the accounting department, applying the payments.
Why is that separation so crucial?
Because if one person controls both receiving the cash and applying it to the customer's account, they have the perfect opportunity, right? They can take the cash and then manipulate the record to hide it. By separating those functions, it becomes significantly harder. One person can't control the whole process from receipt to application. To commit the fraud, then, they'd likely need to collude with someone else.
Which makes it riskier for them?
Much riskier. Collusion dramatically increases the chance of getting caught.
Okay, separation of duties. What else?
Next, a detailed comparison of the bank deposit details and the remittance credit details. This gets a bit more granular.
How so?
It means meticulously matching the individual items listed on a bank deposit slip, like specific check numbers and amounts from specific customers to the specific customer remittance advices that the accounting department is processing and posting to customer accounts.
So you're checking if the check from customer A actually got credited to customer A.
Precisely. If a payment from customer A shows up in the bank deposit details, but the accounting records don't show it applied to customer A's account, or worse, if maybe customer C's payment appears where customer A's should be in the ledger, that immediately highlights a potential diversion. The details don't match.
Got it. Checking the details.
Fourth, something maybe less obvious but surprisingly powerful. The provision of timely statements to customers.
Just sending out regular bills?
Yeah. If customer A, whose payment was diverted, gets a statement showing they still have an outstanding balance when they know they've paid, what are they likely to do?
They're going to call the company and complain.
Yeah.
Or ask what's going on.
Exactly. That customer inquiry forces the fraud out into the open much earlier, often before it can grow really big or become deeply entrenched. It interrupts the fraudster's string of covering payments.
The customer becomes an unintentional detective.
In a way, yes. And following on that, number 5 is confirmation of customer balances. This is often done by an independent party, like an external auditor.
How does that work?
They basically bypass the employee involved in the potential lapping scheme altogether. They directly contact a sample of customers and ask them to confirm, in writing, what their records show as the outstanding balance owed to the company. Any unapplied payments, like customer A's missing payment, will surface immediately because the customer's balance won't match the company's potentially manipulated records. It's an external validation.
Okay, that makes a lot of sense. Multiple angles to catch it. But hang on, you mentioned something really interesting there. Our sources described a system that seems like it could shut down lapping almost entirely right at the source by preventing that initial theft opportunity. It was called the lockbox system.
Ah, yes. The lockbox. You're right, that's often considered one of the most effective methods specifically against lapping because it tackles the root cause, employee access to incoming cash.
So how does it work? What's the mechanism?
It's actually quite straightforward conceptually. Instead of customers sending their payments checks, usually directly to the company's office.
Where that employee might be waiting.
Exactly. Instead, customers are instructed to send their payments directly to the company's bank. The bank sets up a special post office box, the lockbox, or maybe a specific electronic receiving system solely for these customer payments.
So the payments never even reach the company's building.
Correct. When payments arrive at this lockbox address, it's the bank staff who open the envelopes, process the payments, and deposit them directly into the company's designated bank account.
Ah, I see.
The critical control here is that company employees never have physical access to the incoming payments. Since the employee never touches the funds, they simply cannot withhold them for personal use in the first place.
It just completely eliminates that initial opportunity for the lapping scheme to even start.
Precisely. It prevents lapping right at the initial receipt stage. It effectively segregates the custody of cash from the record-keeping function by placing that custody with a trusted, independent third party at the bank right from the very beginning.
So how does the company even know who paid what then if they don't get the checks?
Good question. The bank doesn't just deposit the money. They also send a detailed statement or data file to the company. This typically lists all the payments received, often including scanned images of the checks and the remittance advices that came with them. This allows the company's accounting department to accurately apply the cash receipts to the outstanding customer receivables in their general ledger. They do the recording, but they never handle the physical cash.
Okay, that lockbox system sounds incredibly effective for lapping. Now, let's shift gears to the other scheme you mentioned. Kiting. This one feels different, more like financial trickery. Creating an illusion of money, maybe? Like a magic trick with bank accounts? What exactly is kiting and what's the goal behind it?
You're right, kiting is different. It's less about stealing incoming cash and more about creating a false impression of the cash balance. It cleverly exploits the float period in the banking system.
The float, you mean time it takes for a check to actually clear?
Exactly. That brief window between when a check is deposited in one bank and when the funds are actually physically transferred from the paying bank and become available. Kiting happens when a check drawn on one bank account, let's say Bank A, is deposited into another bank account, say Bank B, but crucially, the company makes no record of the disbursement, the money leaving Bank A, in its own books until after a critical reporting date. Typically, that's year-end.
Okay, so they deposit a check into Bank B, but pretend the money hasn't left Bank A yet. Why? What's the purpose?
The purpose is usually twofold. Sometimes it's used just to cover an existing cash shortage. Maybe someone borrowed money and needs to make the balance look right temporarily. It buys them time.
Yeah.
But more commonly, especially around reporting periods like year-end, it's used to intentionally pad a company's cash position to make it look like they have significantly more cash on hand than they actually do, for financial statement purposes, maybe to meet loan covenants or just look healthier to investors.
Ah, window dressing for the financials.
Precisely. And the deceptive result is an intentional overstatement of cash in those financial statements. Because during that float period, since the disbursement from Bank A hasn't been recorded on the company's books, the same sum of money is simultaneously reflected as being present in two different bank accounts, according to the company's internal records.
Wait, say that again? It's in two places at once on their books.
On their books, yes. Let's walk through a quick example. Imagine Company X writes a check for, say, $100,000 from its account at Bank A. They deposit this check into their account at Bank B on December 30th.
Right before year end.
Exactly. Now, if they're running a kiting scheme, they intentionally don't record that $100,000 check leaving Bank A in their own accounting system until maybe January 2nd.
After year end.
Right. But Bank B, upon receiving the deposit on December 30th, will likely give Company X immediate or at least very quick credit for that $100,000 deposit in their Bank B account balance. So if you, as an auditor or an investor, look at Company X's internal records or their draft balance sheet prepared on December 31st, it will show the original balance plus the $100,000 still sitting in Bank A because the withdrawal wasn't recorded yet, and it will show the $100,000 deposited in Bank B.
So it looks like they have an extra $100,000.
Exactly. But in reality, that $100,000 only physically exists in one place at any given moment during that float period. It's just been double counted on the company's books during that critical reporting window. It makes their liquidity look much, much healthier than it actually is.
Wow. That's quite a sophisticated maneuver. almost like creating ghost money, even if just for a short time. So given this kind of trickery, how do auditors or, financial professionals actually detect this? What are the telltale signs of this kind of illusion?
It is a clever illusion. Detecting it requires specific procedures. One of the primary tools auditors use is the preparation of something called a bank transfer schedule.
Okay, what's that?
It's essentially a schedule that meticulously lists all transfers of cash between a company's different bank accounts. And you pay very close attention to transfers happening near the period end, especially year end.
What are you looking for on that schedule?
There's a critical rule, a very specific pattern that an auditor looks for. For any legitimate bank-to-bank transfer, the disbursement date, the date the check was written and recorded as leaving the first bank, Bank A in our example.
Okay.
That date should always precede the receipt date noted by the receiving bank, Bank B, and recorded in the company's ledger for Bank B. Money has to leave before it arrives, right?
Logically, yes.
So, if this timing is reversed, meaning the receiving account, Bank B, shows the funds arriving before they were recorded as leaving Bank A, or maybe even more suspiciously, if the disbursement and receipt dates are recorded as being identical, especially right around year-end, that's a huge red flag for kiting.
Because it shows they were counting it in both places at the same time.
Precisely. It indicates the company might be reporting the cash in both accounts simultaneously during that float period when physically it could only be in one.
Okay, the bank transfer schedule, is that enough?
It's a key tool, but auditors usually need more definitive assurance. They also need compelling evidence that all the reconciling items on the year-end bank reconciliation, things like deposits in transit and outstanding checks, actually cleared the bank in the very next period.
How'd they get that evidence?
They use a specific document called a bank cutoff statement. This isn't the regular monthly statement. The auditor obtains this directly from the bank, not through the client, which is critical for its independence.
Okay, direct from the bank. What does it cover?
It typically covers the first, say, 10 to 15 business days immediately after the company's year-end date.
So the first couple of weeks of January for a December 31st year-end.
Exactly. And the firm expectation is that all those reconciling items listed on the December 31st bank reconciliation, deposits the company made on the 31st that the bank hadn't processed yet, or checks the company wrote in late December that the recipient hadn't cashed yet, all those items should generally clear and appear on this cutoff statement within that short 10 to 15-day window.
Most things should clear pretty quickly.
They should. So any item, whether it's a deposit in transit that doesn't show up as credited on the cutoff statement or an outstanding check that doesn't show up as paid, any item that fails to clear within this specific cutoff period needs to be investigated thoroughly by the auditor, working with the client to understand why.
Why is that such a big deal if something doesn't clear?
Because it's a strong indicator of potential problems. It could be an error, sure. But it could also be a sign of kiting. Maybe that deposit wasn't real or the check disbursement date was manipulated. It could also indicate other issues, like a check that was recorded but never actually mailed. Uncleared items must be resolved.
Okay, that cutoff statement sounds crucial. And this really highlights something you mentioned earlier. Why is year-end so critical for catching kiting? Why the focus then?
Yeah, it's primarily because year-end is the time when companies prepare their formal financial statements. It's when they're often subject to external audits.
Right, high scrutiny time.
Exactly. So a company that might be facing liquidity problems, or maybe just wants to artificially boost its apparent cash position for investors or lenders or to meet bonus targets, they would strategically choose this time right before year-end to execute a kiting scheme. It directly impacts the reported cash balance on their year-end balance sheet, making their financial health look deceptively better than it truly is, precisely when people are paying the most attention. The stakes are just higher at year-end.
Okay, so we've seen these pretty ingenious, but also deeply damaging fraud schemes, lapping, kiting. It paints a picture of, well, constant vulnerability around cash. But businesses aren't just helpless victims, right? What are the fundamental practical ways they can actually protect their cash? How do they build that fortress you mentioned earlier to guard against these kinds of deceptions?
You're absolutely right. The risks are definitely high, but effective internal controls can and do build a very strong defense. And our sources are unanimous on this. Segregation of duties, often abbreviated SOD, is the undisputed cornerstone. It's the foundational pillar of control over cash.
Segregation of duties. We touched on that with lapping. Can you unpack that concept a bit more? Why is it so fundamental?
The profound insight behind segregation of duties isn't just about, dividing up tasks to be more efficient. It's about deliberately engineering a system where committing and concealing fraud requires collusion between two or more people.
Ah, so one person can't do it all themselves.
Exactly. If one person has the ability to both commit the fraud and alter the records to hide it, the system is fundamentally broken. SOD aims to make fraud a conspiracy, not a solo act. And conspiracies are much harder to maintain and easier to detect because it requires multiple individuals to be dishonest and trust each other and keep the secret. The chances of someone making a mistake or having second thoughts or just tipping someone off increase dramatically.
Makes sense. More people involved, more risk of discovery. So how does this apply specifically to cash? What duties need to be segregated?
Within the cash cycle, proper SOD demands really careful consideration of several specific areas. For instance, you need to think carefully about check writing authority. Who can actually sign checks?
Right.
Ideally, the person who prepares the checks, fills them out or enters them into the system, should not be the same person who has the authority to sign them.
Okay, preparer versus signer.
And the person who signs the checks ideally shouldn't be the one who approved the underlying payment in the first place, nor should they be the one who reconciles the bank statement later on.
Wow, okay, so potentially 3 or 4 different people involved just in paying a bill.
For strong control, yes. It prevents unauthorized payments from being initiated, executed, and hidden by just one person. But the most critical separation, the one that's absolutely non-negotiable for cash, involves 3 key functions.
Okay.
1, cash handling. This is the actual physical receipt or disbursement of money, touching the cash or checks.
Got it. Custody.
2, record keeping. This is entering the transactions into the accounting system, posting to the general ledger or subledgers.
Your books.
And 3, reconciliation of bank statements. This is comparing the company's internal records to the bank's independent records to identify differences.
The verification step.
Okay.
Handling, recording, reconciling. Why is separating these 3 so vital?
Let's think about what happens if you combine them. If one person handles the incoming cash, they could easily pocket some, right?
Sure. Opportunity.
Now, if that same person also keeps the records, what can they do?
They can just not record the cash they took or record it incorrectly.
Exactly. They can manipulate the ledger to conceal the theft. Maybe they don't record the receipt at all, or they apply it to the wrong account, like in lapping. Now, add the third function.
Yep.
If that same person also reconciles the bank statements.
They can just force the reconciliation to match.
Yeah.
Hide the discrepancy.
Precisely. They can create fictitious reconciling items or manipulate the numbers to make everything look like it balances, even though cash is missing. By separating these 3 functions, custody, recording, and reconciliation, you ensure that there are independent checks built into the process. One person collects or pays, another records it, and a third person verifies that the recording matches the external bank statement.
So nobody has complete control from start to finish.
That's the goal. It creates a system of built-in checks and balances. It significantly reduces the opportunity for one person to both commit and conceal fraud involving cash.
Okay, that makes perfect sense. What about smaller amounts, like petty cash?
Good question. Even for petty cash, the principles apply. There should still be separation of petty cash activities from other larger cash functions. Petty cash, even though the amounts might be small individually, is still cash. It's highly susceptible to abuse if not properly managed. So you still need separate responsibilities for, say, who holds the petty cash custody, who can authorize withdrawals from it, and who handles the replenishment and reconciliation process. You wouldn't want the person holding the cash to also be the only one approving withdrawals and reconciling the fund.
Right, same principles, smaller scale. Now, beyond this crucial segregation of duties, what other major controls do businesses use? Our sources mentioned something called a voucher system.
Yes, absolutely. Beyond SOD, a really strong system of internal control for cash relies heavily on the implementation and consistent use of a voucher system for cash disbursements.
Wait, what exactly is a voucher system?
Think of it as a highly structured process. It involves rigorous approvals and comprehensive documentation that must be completed, checked, and authorized before any cash disbursement, any payment is made.
So like a whole package of paperwork for every single check.
Pretty much, whether physical paper or electronic documents. The core idea is that every payment must be supported by a complete voucher package. This package typically includes several key documents. You'd usually have the purchase requisition, the initial internal request for goods or services,
Okay.
then the purchase order, the formal order sent to the vendor, then the receiving report, critical evidence confirming that the goods were actually received or the services were actually performed.
Proof you got what you ordered.
Exactly. And finally, the vendor invoiced the bill from the supplier detailing what's owed. In a proper voucher system, all these documents are collected, meticulously matched against each other. Do the quantities match? Do the prices match? And then formally approved, often by different individuals at different stages, before a check is even prepared, let alone signed and sent.
Oh, that sounds thorough. How does that strengthen control specifically for cash disbursements?
It strengthens control immensely because it ensures several things simultaneously. First, that all payments are properly authorized. Someone couldn't just decide to pay a friend's company. Second, it ensures payments are for legitimate business purposes evidenced by the receiving report and purchase order. Third, it ensures the amount being paid is correct by matching the invoice to the PO and receiving report. And finally, it ensures the payment is accurately documented and recorded. This significantly reduces the risk of paying for things not received, paying the wrong amount, making duplicate payments, or making outright fraudulent payments to fictitious vendors. It creates a robust audit trail, paper or digital, for every single outflow of cash.
Okay, this is great. We have segregation of duties. We have this voucher system. These controls sound pretty robust. But how do we know if they're actually working the way they're supposed to? Or, maybe more importantly, if there are weaknesses or issues, how do those actually get uncovered? This sounds like where the auditors come in, right? What does an auditor actually do when they examine this whole cash cycle? How do they become that financial detective we talked about?
That's exactly right. Having controls is one thing. Verifying they're effective and that the underlying numbers are correct is another. That's the auditor's job. They employ a whole suite of specific procedures, each designed to gather objective evidence about the financial statement assertions related to cash. Things like, does the cash actually exist? Is it valued correctly? Are all cash transactions recorded? When auditing the cash cycle, these procedures generally fall into three main areas, almost like phases of an investigation. First, they audit the ending cash balance itself. Second, they audit the flow of cash, or the receipts and disbursements that happen throughout the year. And finally, they audit how cash is presented and disclosed in the financial statements. So, starting with that first area, auditing the ending cash balance. The primary audit procedures here, the real workhorses for testing completeness, is all the cash accounted for. Valuation and allocation, is it recorded at the right amount? And existence, does the cash actually exist? Are the bank confirmation process and the detailed audit of the year-end bank reconciliation. These two are absolutely fundamental. They provide crucial evidence, both from external sources and internal records.
Okay, let's break those down. The bank confirmation. That sounds straightforward, just asking the bank how much money the company has.
It sounds straightforward, but it's actually a very specific, formalized process. Auditors use a standardized form, typically called the standard form, to confirm account balance information with financial institutions. And crucially, this form is sent directly by the auditor to all banks the client has done business with during the year.
All of them. Even if the company closed an account and has a zero balance there at year end.
Yes, absolutely, even if there's no year-end balance to confirm. And that's a really important point. Sending it to all banks is vital because the bank confirmation verifies much more than just a simple cash balance.
Oh. What else does it ask for?
It also requests crucial details about any actual loans the client might have with that bank, the amount outstanding, the interest rate, the collateral pledged, the repayment terms. It asks about potential contingent liabilities. The bank might be aware of things like loan guarantees the company has made for others or letters of credit outstanding.
Things that might not show up directly as debt on the balance sheet.
Exactly, potential future obligations. It also asks about discounted notes receivable situations where the company might have essentially borrowed money from the bank using its customer IOUs as collateral. And as I mentioned, it confirms any pledged assets the company has used as collateral, which might restrict their use. It also asks about guarantee or security agreements that might restrict how the company can use its cash.
Wow, so it's a much broader inquiry than just what's the checking account balance.
Much broader. It aims to get a full picture of the client's entire financial relationship with that bank, uncovering potential hidden liabilities or restrictions on cash that might not be obvious just from looking at the company's own books. If you look at a sample form, you'll see fields for account details, yes, but also specific sections for loans, contingent liabilities, and importantly, a space for the bank to note any exceptions or additional comments.
And how is it handled? Does the company fill it out?
The company usually prepares the basic information, like account numbers, but often the balance amounts are deliberately left blank by the auditor before sending. The form is then sent directly by the auditor to the bank. And critically, the bank sends the completed form directly back to the auditor.
So the client never touches the confirmed information.
Correct. This direct communication ensures the independence and reliability of the evidence. It prevents any possibility of the client altering the bank's response.
Okay, that bank confirmation sounds powerful. What's the second key procedure for the ending balance? The bank reconciliation.
Right. The audit of the year-end bank reconciliation. This is where the auditor takes the reconciliation statement prepared by the client, the document that explains the differences between the cash balance on the company's books and the balance shown on the bank statement, and meticulously tests it. This has to be done for every significant bank account the company holds.
And what does testing it involve? What steps do they take?
It involves several distinct steps to verify its accuracy and the validity of the reconciling items. First, the auditor performs footing on the bank reconciliation itself and also on the supporting list of outstanding checks.
Footing. What does that mean?
Footing simply means adding up all the columns of numbers on the reconciliation and the checklist to ensure they are mathematically accurate. It's a basic check, but you'd be surprised how often simple addition errors can occur, sometimes even intentionally to hide something. It confirms the reconciliation is numerically sound before you dig deeper.
Okay, step one. Check the math. What's next?
Step two. The auditor agrees the balance per books shown on the top of the bank reconciliation to the corresponding cash account balance in the company's general ledger.
Making sure the starting point on the reconciliation matches the company's official accounting records.
Exactly. It verifies internal consistency, that the reconciliation is actually reconciling the correct book balance.
Okay. Step three.
Step three. The auditor agrees the balance per bank shown on the reconciliation to the balance that was reported on the bank confirmation we just discussed.
Connecting the reconciliation to that independent external evidence from the bank.
Precisely. This is a crucial cross-check. It verifies that the bank balance used as the starting point on the reconciliation is accurate and matches what the bank itself reported directly to the auditor. It bridges the internal document with external reality.
Got it. What's step four? This sounds like where the real detective work happens.
It often is. Step four is where the auditor agrees the major reconciling items, specifically the deposits in transit and the outstanding checks listed on the year-end reconciliation, to that cutoff bank statement.
Okay, let's revisit that cutoff statement again. Direct from the bank covers the first 10-15 days after year-end.
Correct. And the auditor meticulously traces each deposit in transit listed on the December 31st reconciliation to see if it actually appeared as a credit on that January cutoff statement. Similarly, they trace each outstanding check from the December 31st list to see if it cleared and appeared as a debit on the cutoff statement.
And the expectation is they should all clear within that short period.
Generally, yes. Most legitimate reconciling items from year-end should clear the bank within the first week or two of the next period. So this step is critical for validating those items.
What if they don't clear? What if a big deposit in transit from Duck 1031st still hasn't shown up by Jan 15th? Or a large check is still outstanding?
That's a major red flag. Any reconciling item from year-end that does not clear on the cutoff bank statement within that reasonable time frame must be thoroughly investigated by the auditor. They need to understand why. Was the deposit fictitious? Was the check recorded but never sent? Could it be related to a kiting scheme where the deposit wasn't real or the check timing was manipulated? Failure to clear requires resolution with the client and could indicate errors or, more seriously, fraud. It challenges the validity of those reconciling items and, by extension, the accuracy of the year-end cash balance itself.
Okay, it's really clear that auditing that ending balance is intense. But you mentioned it's not just about the snapshot at year-end. It's also about the flow of cash throughout the entire year. Businesses have, potentially thousands, millions of cash receipts and disbursements happening daily. How on earth do auditors check that? That sounds like trying to count grains of sand.
It can seem overwhelming, but that's precisely where those dual-purpose tests we mentioned earlier come into play. They're incredibly efficient.
Right, dual purpose, because they test controls and the transaction details at the same time.
Exactly. They let the auditor assess if the company's internal controls over cash transactions, that fortress we talked about, are actually operating effectively, while simultaneously gathering substantive evidence about the accuracy and validity of the individual transactions themselves. Are the numbers right? Did they actually happen? They provide assurance on both the process and the results, usually by testing a representative sample of transactions throughout the period.
Okay, so how do they do that? You mentioned tracing and vouching.
Yes, those are the two core techniques auditors use here, applied across different financial statement assertions. Remember, tracing generally goes forward from source documents to the accounting records, primarily to test for completeness. Did everything that should have been recorded get recorded?
Okay, source to record for completeness.
And vouching generally goes backward from the accounting records back to the underlying source documents, primarily to test for existence or occurrence, and often accuracy. Did the recorded transaction actually happen, and was it recorded for the right amount?
Got it. Record back to source for existence and accuracy. So how do they apply these? Let's start with completeness. How do they check if all cash receipts and disbursements were actually recorded?
Okay, for cash receipts completeness, the auditor will typically take a sample of original remittance advices, those slips customers send with payments.
Right, proof of payment received.
And they will trace these forward. They'll follow them from, say, the mailroom log or initial receiving point into the cash receipts journal, the company's detailed listing of all cash received, and then further trace the total from the journal entry to the corresponding deposit slip and ultimately to the credit appearing on the bank statement.
So following the money from the customer's advice all the way to the bank deposit record.
Exactly. If a remittance advice exists indicating cash was received, but you can't trace it into the cash receipts journal or find a corresponding deposit, that's a strong indicator that cash received might not have been recorded. It could have been diverted.
Okay, that makes sense for receipts. What about cash disbursements completeness? Making sure all payments made were recorded.
For disbursements completeness, the auditor often works from the bank's perspective. They'll take a sample of canceled checks that have actually cleared the company's bank account,
Proof the money went out.
and they will trace these back to the cash disbursements journal, the company's record of all checks issued. This confirms that every check that actually left the bank account was properly recorded in the company's books. If you find a canceled check paid by the bank, but there's no corresponding entry in the disbursement journal, it could indicate an unrecorded expense, maybe an unauthorized payment, or just a significant recording error.
Gotcha. Now, what about cutoff? Making sure transactions land in the right accounting period. You mentioned this was key for kiting too?
Absolutely critical for accurate financial reporting. Auditors meticulously verify the cutoff of both cash receipts and cash disbursements right around year-end, looking at transactions occurring, say, the last few days of the current year and the first few days of the next year.
What are they comparing?
They compare dates. For cash receipts, they'll compare the date the receipt was recorded in the cash receipts journal versus the date the deposit actually showed up on the bank statement, especially looking at that cutoff statement. For cash disbursements, they'll compare the date the check was recorded in the disbursement journal versus the date the check actually cleared the bank, again, often using the cutoff statement.
And what are they looking for?
They're looking for consistency and logic. Receipts recorded in December should ideally be deposited in late December or very early January. Checks recorded in December should clear around then or shortly after. Any significant delays or inconsistencies, like receipts recorded on December 31st but not deposited until Jan 10th, or checks recorded December 31st that don't clear until February, need investigation. It could indicate intentional manipulation to shift revenue or expenses between periods or other processing issues.
Okay, cutoff is about timing. What about valuation, allocation, and accuracy? Making sure the dollar amounts are correct.
Right. Are the numbers right? For cash receipts accuracy, the auditor might take a sample of daily deposits. They would then add up all the individual remittance advices or listing of checks included in that deposit. They'd also foot the details on the actual deposit slip prepared by the company. Then they agree these totals to the amount recorded in the cash receipts journal for that day, and finally to the amount actually credited by the bank on the bank statement.
So checking the math at every step of the deposit process.
Pretty much. It verifies the mathematical accuracy and ensures the correct total amount was recorded and banked. For cash disbursements accuracy, they often go back to those voucher packages we discussed.
The whole bundle of documents supporting a payment?
Exactly. They'll select a sample of recorded disbursements from the journal. For each one, they'll pull the entire voucher package, the purchase order, receiving report, invoice. They meticulously agree the details, and crucially, the amount across all these documents, comparing them to the amount on the canceled check itself and the amount recorded in the disbursement journal.
Ensuring everything matches up?
Right.
And the payment was for the right amount.
Precisely. It ensures the payment was for a legitimate, supported purchase, that the amount paid matches the approved invoice, and that it was recorded correctly. It's a detailed check against errors or overpayments.
Okay, that covers accuracy. Now, what about existence and occurrence? How do they prove the recorded transactions actually happened? This sounds like the vouching you mentioned.
Exactly. This is where vouching comes in, going from the record back to the source. For cash receipts' existence, the auditor will select a sample of entries from the cash receipts journal and vouch them back to the underlying supporting documents. They'll look for the corresponding remittance advice, the validated deposit slip, and the credit entry on the bank statement.
So, starting with the journal entry and finding the proof it was real.
Yes. Finding that supporting documentation confirms that the recorded receipt actually occurred and wasn't just, a fictitious entry made to inflate revenues or cover something else up. For cash disbursements occurrence, similarly, the auditor selects a sample of entries from the cash disbursements journal and vouches them back. They'll look for the corresponding canceled check, proof it was paid by the bank, the complete approved voucher package, proof it was authorized and supported, and the debit entry on the bank statement.
Again, proving the recorded payment actually happened and was legitimate.
Correct. It confirms the disbursement wasn't fictitious, that it was properly authorized via the voucher system, and that it actually cleared the bank.
Okay, one last piece here for the transactions. Understandability of presentation and classification. What's that about? Making sure things are in the right buckets.
Essentially, yes. Are cash transactions being categorized correctly in the financial statements? Auditors will examine a sample of remittance advices for receipts and canceled checks voucher packages for disbursements, along with how they were recorded in the journals to verify they were posted to the proper general ledger accounts.
Why does that matter? Isn't cash just cash?
Well, yes, but where it came from or where it went matters a lot for understanding the business. Was that cash receipt revenue from sales, or was it proceeds from selling equipment? Was that cash disbursement for office supplies, an expense, or was it to purchase a new machine, an asset? Misclassifying transactions can significantly distort the picture of profitability, assets, or liabilities presented in the financial statements. This check ensures transactions end up in the right category so users can understand the financial statements correctly.
All right, this has been incredibly detailed on the balances and the transactions. But you mentioned the third area auditors look at, presentation and disclosure. Beyond just the raw numbers and the flow, how a company actually presents its cash information to the public, like in the footnotes of financial statements. Yeah. That's also really important, isn't it? It's about transparency, making sure users get the full story.
Absolutely critical. Auditing presentation and disclosure is all about ensuring that transparency and clarity. It focuses on the footnotes and other accompanying information in the financial statements. This part ensures that all the relevant context about the company's cash position and policies is clearly communicated, allowing users, investors, lenders, you to make truly informed decisions. You need the narrative to understand the numbers.
So what are they looking for here? Let's start with completeness again. What needs to be completely disclosed about cash?
For completeness and disclosures, the auditor must ensure that all required disclosures related to cash have actually been included in the notes to the financial statements. These aren't optional nice-to-haves. They're requirements under accounting standards, precisely because they provide critical context.
Okay, what kind of disclosures are typically required for cash?
Several key ones. For example, the company must disclose its specific policy defining what it considers to be cash and cash equivalents. This is crucial because cash on the balance sheet isn't always just money in the checking account.
Right, could include other things.
It often includes cash equivalents, highly liquid, short-term investments that are readily convertible to known amounts of cash and have very insignificant risk of changing value. Think short-term government securities or money market funds. The company's policy needs to clearly state the criteria, often something like investments maturing within 90 days of purchase. Disclosing this policy tells users exactly what's included in that balance sheet number, which significantly impacts how you assess the company's true immediate liquidity.
Okay, definition policy. What else?
Another critical area is disclosing any restrictions on cash. Is all the cash shown on the balance sheet actually available for general use?
Maybe not. Like that lockbox money before it's processed. Or something else.
Well, the lockbox funds become available quickly. But think about things like sinking fund requirements. A company might have issued bonds and be legally required by the bond agreement to set aside cash in a separate restricted account each year, specifically to repay those bonds when they mature. That cash isn't freely available for day-to-day operations, even though it's technically the company's cash.
So it's earmarked, restricted.
Exactly. Or consider compensating balance requirements. Banks sometimes require companies to maintain a certain minimum balance in their checking account as a condition for a loan or a line of credit.
Like a security deposit almost.
Sort of. It effectively restricts that portion of the cash balance, making it unavailable for general use. Failing to disclose these kinds of restrictions, sinking funds, compensating balances, maybe cash pledged as collateral for a loan, would seriously misrepresent the company's true liquidity position. The auditor has to verify that all such material restrictions are fully and clearly disclosed in the footnotes.
Okay, that makes sense. Completeness is about getting all the required context in there. What about valuation, allocation, and accuracy for disclosures?
Here, the auditor meticulously reads all the footnotes and other information related to cash disclosures. They're checking whether the narrative information presented is accurate, consistent with the financial statements themselves, and presented using appropriate amounts where necessary. Does the story told in the footnotes align with the numbers on the balance sheet and cash flow statement? Is the language precise?
Ensuring the words match the numbers,
Yeah.
basically.
Essentially, yes. And also checking rights and obligations and occurrence for disclosures. How do they do that? They compare the information in the disclosures back to other audit evidence gathered throughout the entire audit. This is about verifying that the disclosed information is factual, that it represents actual events, rights, or obligations, and isn't just made up or misrepresented.
Can you give an example?
Sure. If the footnotes disclose a compensating balance requirement related to a specific loan, the auditor doesn't just take the company's word for it. They will verify the existence and the specific terms of that requirement by examining the actual loan agreement document and by checking the information received on the bank confirmation form that was sent directly to that bank. It ties the narrative disclosure back to concrete, independent evidence, confirming the company both has the obligation, the compensating balance, and the right to the loan, presumably.
Okay, tying it all together. And finally, understandability of presentation and classification for disclosures, making sure people can actually figure out what it means.
Exactly. Clarity is absolutely paramount here. The auditor reads all the cash-related disclosures from the perspective of a reasonably informed user of financial statements. Is the language clear and unambiguous? Is it free from excessive jargon or overly technical terms? Is the information presented logically and in a way that's relatively easy to digest? The goal is to ensure that the disclosures actually help users understand the company's cash situation, not confuse them further. It's about empowering the user with clear, understandable information, not just fulfilling a technical requirement. Financial statements are communication tools, after all.
Wow. Okay. That was a truly comprehensive deep dive into the cash cycle. Seriously, from those, cunning ways fraud can happen, like that endlessly shifting hole of lapping or the ghost money illusion of kiting, all the way through to the incredibly meticulous, detailed steps auditors take to try and protect financial integrity.
Yeah.
We've covered a tremendous amount of ground.
It's a critical area with lots of moving parts.
It really makes you realize, doesn't it, how much businesses and the whole financial system really rely on this delicate web of trust, but also rigorous oversight and verification.
Trust but verify, as they say.
Yeah. We've seen exactly why cash is inherently so high risk. We've seen how critical those internal controls are, especially that fundamental idea of segregating duties in building that fortress around it. And we've walked through the incredibly detailed procedures auditors use, from getting those confirmations directly from banks to tracing and vouching individual transactions and making sure the disclosures tell the full, clear story.
It's a multi-layered defense system.
So what does this all mean for you listening right now, whether you're maybe managing a small business or perhaps studying to be a financial professional, or maybe you're just someone who wants to understand the world a bit better? I think it means really appreciating the immense complexity that can lie behind seemingly simple financial numbers.
It's always more beneath the surface.
It absolutely highlights the importance of checks and balances in any system, not just financial ones. And ultimately, I think it underscores how continuous vigilance, that sort of detective mindset, is just key to safeguarding financial resources in any organization, big or small.
That's a great summary. And if we try to connect this to the even bigger picture, This deep dive into something as fundamental as the cash cycle really highlights that even in our world, which is becoming increasingly digital, increasingly automated, those fundamental principles of trust, transparency, and accountability, the very things tested and hopefully upheld within the cash cycle, they remain absolutely paramount, maybe even more so.
That's an interesting point. Why more so now?
Well, it raises an important question, I think. As organizations continue to innovate financially, exploring new payment methods like cryptocurrencies, instant digital transfers, complex financial instruments, how do they do that while simultaneously upholding the strongest possible internal safeguards in this landscape that's evolving so rapidly? The methods of moving money change, the speed changes, but the core risks, theft, misrepresentation, error, they might just change shape. The need for robust control, for clear audit trails, for that vigilance you mentioned, it's always going to be there. It's a constant challenge of balancing innovation with security.
Balancing innovation with security in a rapidly changing world, that is definitely something to think about. A great final thought.
Hopefully gives people something to mull over.
Absolutely. Well, that's all the time we have for this deep dive. Until next time, keep digging for knowledge and stay well informed.